Hi there, traders. Today we're going to discuss why trading is very similar to sports, especially when it comes to martial arts. I've been doing Taekwondo now for the past 38 years and Brazilian Jiu-Jitsu for the past 12 to 13 years. Actually, it's my 13th year. But nevertheless, why is trading very similar to martial arts? Well, I'll tell you why. Number one, even though it has no physical contact, but the mental game of it is very similar to martial arts. And when you are trading, there is an offense, there is a defense. So in martial arts, I say stand up and saying Taekwondo, it's fast and reaction time is well needed. Thinking is a no-no. And the reason is because every single movement, either you're punching or kicking, there's that speed aspect. So very similar to scalping when you are a day trader and you're scalping the markets. It's a very quick reaction there and then, or a momentum type of trading environment there and then. So for me, and based on my trading style, is very similar to Brazilian Jiu-Jitsu. Why? Because you have to take your time. For Brazilian Jiu-Jitsu, it's not about the speed. It's the slower you get. It's mainly about the technique, the leverage, and we call it, Jiu-Jitsu athletes or basically practitioners call it as mainly as a human chess game or chess match. Why? Because it has almost unlimited different ways in order to submit another person. You have two arms, two legs, plus you can roll 360 degrees. This way it makes more challenging than Taekwondo or any form of stand-up, because you can either be lateral, unilateral, forward, back, side to side, and that's basically it. And you can only have a certain amount of combinations of punches and kicks, but it's simply more of the strategy implemented when you are fighting or on a stand-up. However, now when you are on the ground and you're grappling with Brazilian Jiu-Jitsu, it's so different. So in trading, in my opinion, is very the same. There has to be some form of transition, what we call transitioning from one game to the other. So from a seller to a buyer to a buyer to a seller. So those combination is very, there's pretty much nothing, like it's very limited compared to, say, Brazilian Jiu-Jitsu, where there's a lot of different ways or combinations to do it or to submit another person. So I'm going to share with you basically how I played the game with the S&P 500 and so just to see here, I'm going to move this here to the top right-hand corner so you can still see me. If you look at the timestamp in terms of selling, I've been shorting the S&P since the 21st of July. So here at 43.60, and I've been basically accumulating shorts with the S&P. Knowing overall, I'm still basically in an uptrend. So the question is, if you are have a forecast and you are projecting that the price is going to go to the downside, yet it is going up, of course, there's certain dangers with that. Mind you, I'm being on defensive while the market is being offensive. So the question is, how can you play a game where you can't basically win? You have to go with it. From an overall perspective, based on the evidence being shown or factual evidence being shown to me as a trader, there's a lot of divergence happening. The market is not sustainable. Then from a longer perspective, the markets are basically going to short, and hence institutions have also, based on commitment of traders, there's evidence that institutions have been shorting the markets, but it's just a matter of when is it going to drop? When is it going to correct itself? Overall, still a very bullish trend. It's an uptrend, but it has to correct itself at one point in time. When there's no price points where what we call a price where it keeps going up, but you don't have enough evidence in the past. So what are you going to refer it to? Where it's simply what we call in a blue sky territory. Blue sky territory simply means that the price has no evidence in the past of where on how far it's going to go. Of course, the risk is unlimited because you don't know on how far these prices are going to go, right? But it's the what after years and years of having mistakes, it is mainly the amount of risk that you're willing to take and the amount of position sizes that you have to put in without blowing your account, that if it keeps going, are you still going to be with the constraints of you not losing so much? Because in the past, I've blown numerous accounts, so basically because of this type of strategy. And to tweak it, to keep tweaking it, it's simply, for me, it's like, say, for Brazilian Jiu-Jitsu would be, okay, the person's on top of me, I can't breathe. What can I do now? Well, if I'm going to bench press the person that's in front of me or that's on top of me, say is a 250 pounder and I'm 149 pounds, 150 pounds, that's another 100 pounds extra. I won't be able to just bench press another extra 100 pounds when someone's on top of me. So what I have to do is inch by inch, bit by bit, being patient, boom, move, until I get a certain, as long as I have a breathing section, a breathing area, then I'll be safe. As long as I don't panic, I'll be safe, because if anxiety kicks in, then things, you get either injured or you are going to tap out. So likewise in trading is that you need to be patient. That's number one. Number two, the amount of risk that you have to put in terms of position size shouldn't be more. So, but if you can see here, I put in at 3. I was just a little bit aggressive because I can see that there is a potential that it could drop. However, it didn't want to do that. It kept going. And hence I reduced the position size bit by bit. And that's where I knew that when it topped out and there's a divergence between volume and price, it was getting to an overbought territory, the odds and probability it's going to fail is more than likely to happen. And so I've been monitoring it simply overnight, especially last night, because I only had basically a few hours sleep, because with this type of scenarios where you just don't know, when something basically has dropped already quite a few amount of points, the only way you can basically do that is basically rebound. So here on the other hand, this is where, from a shorting perspective, close the positions, and then I bought back in here within the price of 43.70. I'm a very big believer of trends. I love using trends. If you know how to draw your trend lines properly and based on algorithms that institutions basically use, they will touch it and then either break it out and then come back in again. And that's what it basically did. It dropped even further, dropped to the 50th percentile of your Fibonacci retracement from the low, from the last low to the last high, and then rebounded to the upside, right? So closed the positions. If you can see here, in terms of the sell, 43, 47, 44.17 was the price. 44.17, 44. I'm sorry, here 43.60, 43.59. So closed those positions, and then I closed 10 or closed basically 89% of the buy positions. Why? Because I still have one short position right here at 43.24 right there. So to play the game, I know that longer term there has more room for it to drop. So once this one basically, that's why I left. So basically I'm hedging those positions now. The odds and probability that it could potentially rebound to the upside, but once that lower high happens, close the long position, short it again until it will reach all the way back down from a long-term perspective. So from a transitioning point of view, there's always transitions with the markets, and luckily with the markets it becomes easier with the transitioning, because it's either transitioning from the downside to the upside, or the upside to the downside. However, the expertise of here. This is where a black belt, and when I say a black belts in Taekwondo and Jiu-Jitsu basically knows in terms of transitioning and whatever technique that will be utilized based on those transitions. Trading, on the other hand, is also knowing it is the timing when to do it, when to buy and when to sell, when to transition from short to long, because as long as we are humans and we have emotions in place, it will no longer follow the logic or the plan because of the lack of awareness, and it will only do what it wants to do from a mental component based on that fear in terms of that limitation. When that fear kicks in and the uncertainty kicks in, and either the person will react to it without knowing and will no longer basically follow the plan. I hope you can follow me. So if you're new to this, it's a little bit more challenging to really probably understand, but if you've been trading up for some time, you will know exactly what I'm talking about. All right, so this is it basically from my discussion for today with you based on our topic, how or why trading is very similar to sports. Well, if you like this type of videos, please make sure to hit me a like and subscribe to our channel. If you have more of this type of videos, to get more of your market updates, right? And other than that, I hope you enjoyed it. Take care till next time. Happy trading, and I'm out. Be awesome.